Welcome to the Divorce the IRS Podcast, the retirement income planning podcast designed specifically for those who want to pay the least amount of taxes possible and build a retirement income that lasts. Inspired by the best-selling book, Divorce the IRS, you get to go behind the scenes with financial planner, author, and speaker Jimmy Miller. Learn how to set yourself up to pay the least amount of taxes in retirement when you'll need your money the most. And now, here's your host, Jimmy Miller.
Welcome to episode 4 of the Divorce the IRS podcast. Today, we're going to debunk a popular tax myth that has been around for a long time and start to learn a bit about how to measure your taxes. As a financial advisor, I get the opportunity to discuss topics like taxes with people almost daily. And after more than 20 years in my profession, I have become acutely aware of how misunderstood taxes are, especially the way our progressive tax system works here in America. And I know too many advisors, more aptly called financial salespeople, who, unfortunately, take advantage of this fact by misrepresenting tax-deferred investments, which we will discuss in more detail in an upcoming episode. If you want to get yourself on a path to divorcing the IRS and achieving a tax-free retirement, you need to understand a few tax basics, including the biggest misconception around and the 2 measurements that are critical to tax planning. Now, have you ever heard someone say they don't want to raise at work, or they don't want to work overtime because it would push them into a higher tax bracket? Have you heard them say something about it wouldn't be worth it, or that they would actually lose money due to the higher taxes? This is a common misconception about tax brackets here in America, and it's one we should dismantle. To put it very simply, if you make $1 over your tax bracket and it places you into the next tax bracket, you pay the higher tax on that $1 only. That's the simplest way to explain this concept. The misconception is that by piercing the higher tax bracket with that $1, all of your money will now be taxed at that higher rate. This is simply false, and the idea needs to be eradicated. The final dollar will indeed be taxed at the higher rate, and you will bring home less of that $1 after taxes paid on it, but it is completely inaccurate to believe that by jumping up a tax bracket, all of your income will be subject to higher taxes. We have a progressive tax system in America, where the first part of your income is tax-free, called the standard deduction, and then as income rises through the brackets, the tax rate for each bracket rises. This creates 2 different ways to measure your taxes, and these need to be understood before we can explore the remaining concepts in this podcast. If you already understand the 2 measurements I'm referring to, marginal and effective tax rates, then just skip to the next episode. Now, marginal tax brackets are the progressive tax brackets and how most people think of and quote their tax rate. Once you have applied your itemized or standard deduction, the money you get to have tax-free each year, then you start into the marginal brackets. You pay the tax rate only for the dollars that fall into each bracket. In 2025, the brackets are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. The amount of income that falls into each bracket is different, depending on whether you file as a single person, a head of household, or married filing jointly. The amount of standard deduction, your tax-free income allowed to you each year, also differs depending on how you file, as well as your age. Now, without going through all the numbers that fill each bracket, because it wouldn't be fun to hear me read all those out loud, I will assume if you're interested in knowing what those numbers are, that you can do a simple Google search for the current tax brackets. Now, let's look at a simple example of this in action. Let's assume you have $50,000 of taxable income after applying your standard deduction, and you're filing single. That means in 2025, you earned your first $15,750 tax-free. So if you have $50,000 in taxable income, you actually made $65,750 in total income and have $50,000 of taxable income after your standard deduction. You would then pay 10% on the first $11,925 of taxable income and 12% on the income between $11,926 and $48,475. Then you would pay 22% on the rest. The total tax bill would be about $5,914, which brings us to your effective tax rate. Your effective tax rate is the average rate you paid on every taxable dollar you earned. This is the more important tax rate to understand, as it is a more accurate reflection of what you pay in taxes, and it evens the playing field when making comparisons or considering a tax strategy. Someone might make $1 in the 35% tax bracket and pay 35% on just that $1, But that hardly makes it accurate for them to say they pay 35% to the IRS, which is how most people talk about their taxes and their tax brackets. From our previous example, the $5,914 that you paid in taxes divided by the $50,000 of taxable income equals an 11.8% effective tax rate. So even though you ended up in the 22% tax bracket, barely, you effectively paid 11.8% of your taxable income in taxes. Now that you understand both marginal and effective tax rates, and we have broken the misconception about tax brackets, we can move on to the concept of the 3 tax buckets. In the next episode, we'll take a look at the categories that all investment accounts fall into, how each category or bucket works, and how to start to understand which one might benefit you more in the long run. Don't forget to hit subscribe if you haven't already, and I'll see you in the next episode.
Want even more ideas, tools, and resources on how to navigate your financial life? Check out all the resources on the Divorce the IRS website at divorce-the-irs.com or the Baobab Wealth website at baobabwealth.com, and subscribe to the blog to stay up to date on issues affecting retirement income planning. Don't forget to subscribe to the podcast so you never miss an episode. Baobab Wealth and Baobab Wealth Abroad are DBAs of Baobab Wealth LLC, a Florida registered investment advisor. This podcast is designed for general education purposes only and shouldn't be taken as legal, investment, or tax advice. You should seek out a qualified tax professional or licensed financial advisor to determine what is best for your personal situation.